let's see this. I want you to see this. Today guys is a very beautiful day. So sorry, I want you to see this. So I want you to see this. Okay. Okay. So sorry guys, sorry. Okay, so let's do this. I want you to see this. I want you to see this. So you can see how the market was pushing here. We had a strong push, a pullback, a push, if you can see, and again a pullback, right? A push, a pullback, a push, a pullback. Now, what I want you to understand is this. You can see how these impulsive moves are happening, right? Now, what you want to know is that this market is in an uptrend because it's breaking these highs. This high is broken and this high is broken. Now, what can you notice? You can also see that these lows here were respected, were not broken, right? So let's just remove that. Now, once you see that those lows were not broken and you see that this market here is bullish, what you're going to see is you're going to have to look for inefficiency in the market. Once you see that the market is pushing up, let me give you an example. Sorry. Once you see the market is pushing up like this, okay, once you see the market is pushing up like this, you are going to need you see that here it started like to try to drop to the downside, right here, right? Yes. Now before that you had this strong push to the upside. This is what you need to see. Now once the market creates that strong push to the upside, you can see here on this level here, it's left inefficiency. All this here was inefficiency, right? And what did it do? It swept these previous highs. Those previous highs are these highs just above here. That high there was swept. Once the market sweeps this previous high, what do you know? We know that it's now going to go to sweep these the previous lows, meaning the market can now go to the downside, right? So how are you going to know that the market's going to go to the downside? What you need to look for is you need to look for impulsive move, where the impulsive move started and where the inefficiency is. Inefficiency means imbalance, okay? Fair value gap. Now look at this. You can see here the market pushed up, it swept these highs here, right? After the market swept the high there, what did it do? The bears came in and this started to push the price lower, if you can see. Once you see this and once you see that, okay, the market has exceeded this previous third candle here, the sellers, the bears has exceeded this third candle here, just know that, okay, the selling pressure is strong. How are you going to know that the selling pressure is strong? Because you are going to look now below here. Look at this. Below this low here, you're going to see that, okay, there is a lot of liquidity listing and there is a lot of inefficiency. The inefficiency is here, whereby there is nothing that can oppose you. There is no resistance. Let me show you this. Let me remove this. There is no resistance because once the market, let me show you like here, once the market is moving like this, up down, right, it's creating resistance. But this war impulsive move here, there is nothing to stop you, right? So you can expect the market to drop to feel the inefficiency and again to pull back up. Okay, so that's the logic behind it. So once you see the market breaks the previous candles, you can look for sales if there is an inefficiency. Okay, so you can see the market breaks this low here, then that would have been your entry, but the entry should be here above you. Once the market taps into this order block that swept the previous high there, okay, that's what you're going to sell. And your stop loss, your first target will be here, your third target will be here, and your fourth target will be here. All right, that's how you're going to trade this one and you're going to make the money. You can see once the market breaks this structure, it came back and again retested this area here because this was a level of resistance. That's where the market came to retest. Okay, so let's go to the next example. You can see the market, as the market was dropping like this, right, breaking this level of structure, making a change of character. What did it do? It left a lot of inefficiency that needs to be filled. So you need now to look for a level where you think the market might reject to go and fill up the inefficiency, and this was the previous level here. That's where the market came and filled the inefficient, and again it gave you the move. So any buyers here, you can see building sell side, buy side liquidity, the sell side liquidity, right? So buyers here started to buy and the market came back down, pull back down, up. Then it takes them out. What did they do? They lost the man, right? And they thought the market is selling, and again they entered the breakout and started selling, and the market took them out. And again the market built again what? Sell side liquidity. Once the market takes out the buy side liquidity, you need now to wait for it to take out the sell side liquidity, or you need to wait for the market to take out. Once the market takes out the low, wait for it to take out the high. And before it takes out the high, you need also to identify the level where you think the market might reject. So the level where I thought the market might reject was this previous high that was breaking the order flow. So if you want me to make a video about the order flow, you can just comment below. Okay, so you can see the market came back to this order flow. All this is the order flow here. That's where the market came to reject. Okay, so let's see. The market breaks the structure. We had this inefficiency again. Let me show you. We had the inefficiency. This here is the inefficiency. Okay, all this here, all this area here is the inefficiency. Okay, we also have the liquidity here and also the, okay, so that's the inefficiency here. Okay, so this here is the inefficiency. So you need now to look for areas where you think the market might reject. So we have this strong, this order flow here. Always order flow is the first thing before an order block. So you wait for the market to go to the order flow to tap. You can see the market taps into the order flow here, and again they give you this strong entry. So if you miss this entry, because where are you going to put your stop loss? Nowhere, right? What you're going to wait is you wait for the market to break this low. Let me show you. You wait for the market to break the low, this one here. Once the market breaks this low here, the one I'm pointing here, you can now look for sales. All right, you can see, and it put back, and you can see, you can even see that here we had the wick that rejected. You can see the market sweeps that high from there. Okay, so the thing I want you to take from this video is you need to identify imbalance, and you need to identify the area of value you think the market is going to reject after thinning out the imbalance, as it did here. You can see here it swept the liquidity and you would have sold, and the target would have been this low here. Okay, so once you see the market fails to break this low here, you need now to wait. This would have been your first TP. You need now to wait. You can see the market pushes back up. What did it do? It breaks this high. Now let's do this. The market breaks here, then what does it do? It didn't pull back to this area, right? This is the head and shoulder. So you can see those who trade the head and shoulders, you can see this is the left shoulder, the right shoulder, and this is the head just down. You can see the market pushed up with strong momentum and it broke the previous highs. So how am I going to enter this one? You need to wait. If the market doesn't give you an entry, you need to wait. It's a sign that the market might come back to return to the level. Okay, so guys, I'll continue recording this video to show you what you can do in the next chapter. So make sure to subscribe and to like the video.